The other big story, the market regulator SEBI has tightened the rules governing rating agencies, enhancing the disclosure norms. SEBI has asked rating agencies to reveal the liquidity position of rated companies. SEBI's move comes in the wake of the IL&FS default saga, which has raised questions on the role of credit rating agencies as well. Yash joins us now with more. Yash, what are the new rules saying?
Well, be it the contagion impact which came from the IL&FS case or the scare around the housing finance companies or NBFCs, both events led to some serious wealth destruction, and essentially in both these events something which was questioned was the rating which was given to these companies. Now, in order to ensure that investment decisions are taken on sound ratings given by CRAs, market regulator SEBI has enhanced the disclosure norms for these CRAs or the credit rating agencies. These disclosure norms have been tightened on all three fronts: the parent or the holding company, the subsidiary or the group company, as well as the CRAs or the credit rating agencies themselves. To start with the first one, as far as group companies or subsidiary companies are concerned, the CRAs will have to provide a rationale when a particular group company is being rated based on a consolidated basis on expectations of any sort of fund infusion in future coming from the parent or the holding company. The CRAs will also have to disclose a list of all subsidiaries under a group company while rating a particular group company to avoid any sort of contagion impact coming from the deterioration in the financial condition of one group company into the other. So that is also an important point. As far as the holding company or the parent company is concerned, the holding company will have to be assessed by any CRA based on liquidity, financial flexibility, as well as any expectation of a financial support which it is willing to provide to any of its subsidiaries or group companies. Many measures have been taken as far as the credit rating agencies are concerned. These credit rating agencies will have to assess the liquidity situation of every rated company and disclose that at regular intervals. Also, they will have to take into account the asset liability mismatch while rating any particular company. Also, very importantly, they will have to consider the bond spreads versus the benchmark yields while rating any particular company. And last but not the least, of course, they'll have to furnish data on any sort of action, a sharp action on the rating which has been given to a company. They will have to disclose this information to exchanges, depositories on a half-yearly basis within 15 days before the end of that half-year period.